Hello everyone, and welcome to Pivot Boss Masters. In today's training, we're going to talk about pinpointing precision entries, which is part of the execution portion of core training. This is a very powerful portion of our training because it gives you guidelines of exactly what we're looking for with regards to looking for certain types of entries, certain types of setups. It gives us some guidelines to go by when we're looking to scout for certain types of entry opportunities, and I also reveal the various types of entry points that a typical setup can have so that you can pick and choose which ones you like to engage. So we have a lot to get to in this training, so let's go ahead and get started. So today we only have one slide, and this is it. And this slide is going to give us the major themes that we're going to look at when we jump into the charts. So after this slide, we'll jump into the charts and look at some of these various scenarios that played out over the last few weeks, including today. Many of these scenarios are scenarios that you can pick out any single day in the market in any instrument. So we're going to look at these in more detail, but first, let's talk about precision entries. The Pivot Boss approach to pinpointing precision entries involves several factors, including understanding the various entry points for a given setup, and your ability to read a market's reaction to key price levels. Reading a market's reaction to key price levels, that's one of the most important aspects that a trader can work on, is sharpening that ability to read a market's reaction to a key price level, because at the end of the day, that's what it's about. How is the market going to react to a new high? How is it going to react to a new low? How is it going to react to value, to LVNs? Those types of key levels. If you see a major reaction where the market is failing to establish acceptance, that's an opportunity to fade right away. If you see acceptance and a drive through those key levels, then that's likely going to spark a price discovery phase, much like we saw today. That's exactly what we saw today. Right in the morning, we knew right away this looks like it could be expansion. It looks like it could spark a continuation in a price discovery phase. And we were in on it before the RTH opened in terms of knowing where we're looking to defend and how to approach the day. Turned out perfect. And it turned out perfect because of the guidelines that I'm going to share here with you now. For those of you that have gone back and watched the prior entry techniques course in the execution portion of our training, there's a slide here that has the execution process, which is this inner box right here. And the execution process right there is what I usually go through when I'm looking to engage the market. It's a process that I didn't even know that I was doing so much, but it was what I was doing. And then when I went back to analyze how and why did I look at those areas and what was I looking at, this is kind of the process that kind of came to me. And it's forecasting, visualize, anticipate, recognize, execute, and manage. And that's kind of the visualization and the process of executing a trade. And forecasting is all about developing the ability to forecast where price may be headed next, and specifically looking for future prices where the market may encounter rejection, right? So if the market may encounter rejection at the previous session's high, then that's a level that we need to pay attention to as the market approaches that level. That's something we can know the day before so that we can anticipate that event. And as we anticipate that event, we can begin to visualize how that may play out. And visualization is all about developing that ability to visualize how the market may move toward your forecasted rejection price, how it may reject or react to that forecasted price, right? If you can visualize that, then you can identify where those proper entry points are, how to manage your trade, where your add backs may be at. If you can't do that process for a given trade opportunity, it's probably not going to turn out in your favor. This is the process you got to go through for everything for the most part, because it's a process that leads to high probability trades, trades that allow you to get paid first at T1, and then allow you to continue to manage your trade toward completion. Anticipation is huge because you have to be able to pay attention to how price behaves as it approaches your forecasted rejection price. You have to learn how to anticipate the upcoming trade opportunity. all parts of anticipation, right? That's very, very important because traders who are able to anticipate the next move or what may happen next or where the next rejection may occur can rest easy, can be patient and disciplined about allowing the market to go and test and reject. And then from there, you can use your ability to read the market's reaction and engage the market if need be. Obviously, recognize is very, very important because this is where prior practice sets in. You already know what your rejection signatures are. You know the types of rejections that the market can usually go through, right? It's double tops, it's failed higher highs, failed new lows, box reversals, those types of things, absorption signatures. All of these are different types of rejections that we need to be able to recognize all the time, because the better we can recognize and anticipate their development, the faster we will be able to trigger entries at the best trade location ahead of the crowd and get paid first at T1. That's the goal. The goal is always get paid first at T1. If you can get a T1 first ahead of the crowd and get it quickly, now you don't have any more pressure on your shoulders. You can rest easy and allow the trade to continue to work its way out, because even if it hits your target, you make money, and if it hits your loss stop, you basically have a break-even trade. So T1 is very important, and that's why identifying where these entry points are for your setups is very, very important. Execution, of course, is very important because you have to be able to execute properly. You have to be able to identify how to set that limit there, how to quickly get to that T1 by judging the proper amount of ticks you need to get to a T1, right? A lot of times that can be based off of average daily range. At times I say if you're trading, day trading or scalping, and you're looking for what is the proper T1 target, I usually say just take 10% of the day's average daily range. For example, right now the ES is trading about 20 handles on average. That means you can play to a T1 target that's about 8 ticks away, 2 points, right? And when you understand that, you can make much better decisions and be on the right side of the market. Managing, of course, managing is all about using our core trade management approaches. Once you know those, again, those are just plug and play. You want to use the 111 or 211, maybe the 11, the 21, whatever technique you want to use, right? I tend to prefer the 211 because you have 4 units there that you can split in many ways. So if you have a 4-unit trade, you can scale half and then have additional legs where you can scale at T2s, T3s. That's usually one of my favorites, but there's many different approaches, and you'll gravitate toward one that's best for you. So execution is really simple. That should be the easiest part, because all you're doing is just placing the trade and letting the trade management play out. That should be the easiest part because it's pre-programmed. But the other stuff can be practiced. So this is how we're going to go about every single opportunity when we're looking to engage the market. Just kind of have that entry execution process in the back of your mind. Again, if you go back to the entry techniques portion of the execution course, you'll get to that slide that talks about all of these various points in the process. Now let's go ahead and go with number 1 right now, knowledge of the setup. Knowledge of the setup, knowing your setups inside and out is extremely important to forecasting and executing successful trades on a consistent basis. Study best case scenarios, worst case scenarios, and learn to anticipate both for each setup. Again, this always goes back to study and practice. If you've been in the trading room for any amount of time, you know that on certain days, like today, like yesterday, I'll usually say, wow, this is a textbook setup right here, or this is a major day type, or this is some major failed range expansion, or this is a great absorption signature to mark up. And the goal with that is that you can take these snapshots of that day, mark it up yourself so that you identify where the best case scenarios are for your entries, how to identify and anticipate ahead of time that that rejection or that setup may occur. You just have to have a robust knowledge of the setups that you're looking to engage. And for me, those setups are there's nothing fancy or special. It's typically speaking, we're looking for failed range expansion. we're looking for rejections. I'm not much of a breakout trader, but we know how to engage breakouts as well. I'd rather look to fade failed range expansion at the opposite edge and then have money in the trade as this thing breaks out through the opposite edge on the other side. That's my favorite breakout trade, not trading at the breakout point. If I trade at the breakout point, it needs to be a day like today, where it's a clear price discovery phase beyond recent highs, and it just drives. And then we know that any pullbacks to that point in the next day or two could still be defended for swing moves. So just knowing your setups inside and out is extremely important. Number two, understand the various entry points to your setups. Every setup has multiple entry locations, from high-risk entries to confirmed entries. Know these entry points so that you execute trades that reach your T1 quickly while experiencing little MAE, maximum adverse excursion. Again, those are my two most important points when it comes to deciding where to enter a trade, where to trigger entries, or what I'm looking for. I want to know, can I get to my T1 quickly? And can I get to my T1 without experiencing a bunch of adverse excursion? I don't want a lot of heat in my trade. And I've done really well with trying to identify those areas that produce the best entry location so that you experience little MAE. That's very, very important to me. And yesterday we talked about becoming an elite trader and focusing on measurables like MAE, like MFE. Because when you are focusing on those in your trade journal and log, you make them a priority to minimize one, maximize the other. And it's almost like a video game, right? It's like a video game, trying to improve your best score, trying to improve your average, trying to improve how you execute these entries and how little the adverse excursion you experience. I mean, that's all very, very important. So having that at the forefront of your mind when you're triggering these entries. Can I get to a T1 quickly? If not, then I'm probably going to hold back, right? If I'm going to experience a lot of heat here because I don't know if that's a good rejection point, I probably don't want to take that trade. And I'm very picky that way because there's lots of trains coming. There's lots of opportunities that the market has. There's no use in taking a crappy trade when there's another good one around the corner. Number three is know day types. Know day types and the primary and counter trend rotations. Understand the various day types and the optimal bidding strategies for each, in addition to the current primary and counter trend rotations. A pitfall that many traders encounter, even experienced traders, is failing to yield to the primary and counter trend rotations of the market. The best odds trades tend to occur in the direction of the primary trend. I mentioned this as a major pitfall for many traders because even experienced traders fall into this trap, which is fading highs, fading highs, fading highs, fading highs, even though we're in an upward price discovery phase trending market, right? They have no concept of the current primary trend and current counter trend rotations, and instead they're trying to be the smart person, the smart trader, and fading new highs at every turn, when today was clearly a buy the dips, defend the pullbacks at LVNs type of day in some of these markets like the ES and NQ, like the YM. They all took off to the upside. So you have to understand the day types and how to engage them. If you didn't know that today could be a price discovery phase ahead of time, or if you didn't identify that early enough in the trading day, today could have been a day where you really got hit hard in your trading accounts. I've said this many, many times before. Days like today was a huge trend day in the market, huge. Many of the markets were up 170% of ADR. I think the YM was up 168% of ADR. I think the NQ was up about 127% of ADR. So nice expansion days. And if you don't know that ahead of time, your account can get hit. And I say many, many times, on a trend day structure like we see today, even the best traders get killed, which means bad traders get murdered. Their accounts are just completely destroyed because all it takes is one bad trade at the very beginning of the day, and then you not holding that stop, and then the thing just relentlessly goes against you. It ain't coming back. And that's how you'll get a drawdown of 30% in your account in one day, because you over leverage yourself selling futures, and then boom, the thing runs up and you're like, oh, I don't want to get out now, I'd lose too much. and it continues to push in your direction. As a matter of fact, I remember FT71 saying that the same thing to confirm exactly what I said, but he said it in terms of his brokerage. He said, you know what, in the current trend day structure, I noticed that a lot of the accounts that we managed, or that were at our brokerage, we saw lots of traders who really had trouble on a day like today, and we had to cut off their accounts so they don't just go to zero. And that goes for even pro traders. So again, you got to be humble about the approach. You got to be diligent about the patience and discipline that you experience in waiting for these key opportunities. You have to know your day types. You have to know the primary and counter trend rotations. Today was a day about buying pullbacks, buying counter trend rotations in the direction of the primary trend. And again, it goes back to knowing day types. Yesterday was completely different. Yesterday, the ES and the NQ gapped up big, so I started the morning saying, today's likely going to be a trading range day, fade the edges. Again, you've got to know your day types and what to look for. If you don't know that ahead of time, again, it could be very, very bad for you. Number 4, sharpen your ability to read a market's reaction to key prices. I think, in my opinion, that this is the most important skill that you can develop as a trader, is the ability to read a market's reaction to key price levels. Key price levels like previous high-low close, right? Key price levels like the previous high-low close, overnight highs, overnight lows, low volume nodes, all of these are very, very important price levels. And when the market goes to that price level, it's a decision point. Are we going to push through or are we going to fail? It's a decision point. And that's why I like those edges, because they are decision points. Something's got to give. Now that we're at an edge, are we going to see expansion or are we going to see failure? It's one of the two. Yes, we can just die at that level and just go sideways, but that's not usually the case. So that's why I like to engage those levels. But it's not just about engaging the level, it's about identifying and understanding how the market is reacting to that level. Is the market really reacting and rejecting? If not, then it may not be an opportunity to engage. But if you're seeing some sort of significant rejection, that's an opportunity to engage and fade. Number 5 is confirming with order flow. Once a significant market reaction has occurred at a key level, begin to confirm your preferred trade location with order flow, either via the footprint and or the visual dome. Order flow will determine whether the setup works or fails. That's always the case, right? And this is something we talked about today. This is something we did live in the trading room today, where we knew that the market was trending up before the RTH opened. We saw the ES push through 76.5, and that's the key level. That's the major level on the board, was 76.5. If we were going to push through it, we were likely going to go up toward 88, 89. That's something we just thought based off of ADR. We took the current day's low, we forecasted it up, and we said, you know what, we might be able to get up toward 88, 89 over time. So what did we do? We pulled up the chart, looked to defend LVNs, looked to defend the PIMA pullback trigger zone, and from there we looked at the trail of intentions indicator, which is the visual dome. We also looked at the footprint, and we were able to identify all these trap sellers that were coming in and were not getting paid. And once that happened, we knew that a fade was likely coming, and a quick fade did ensue up to 87s. It was a highly confirmed opportunity, but we knew where to look, we knew the day type, we knew where to look to identify our trade location, and then we went down to the order flow to confirm it, and we knew with a high certainty that at that moment we were likely going to see a squeeze. That was fantastic. And number 6 here is patience and discipline. Be patient and practice discipline while seeking to execute entries at the best possible price during markets experiencing great pace and tempo. Look to avoid forcing trades during markets that lack energy or follow-through. Yesterday was one of those days that was very quiet and boring. Not a whole lot of follow-through. We at least knew what to look for. Yesterday we talked about looking to defend 65s in the ES, and the low was 65.75, right? We weren't trying to sit up there and buy 67, 68s or anything. It's, hey, if we get down to 65s, that's a zone to begin looking for rejection, because you might be able to return it to 74. And the market did go right back to 74 by the end of the day. Again, because it was a trading range market, but it was slow. It was boring. It lacked energy. Today, much different day. Much more pace and tempo, great energy, great rotations, great counter-trend rotations on some of these markets, and there was plenty of room to defend and squeeze. Do you ever look at other markets to help you make a decision? That's a great question here. I think it's a very helpful approach. And the first time I started to do it was when I would look to the TF, which is the Russell 2000 futures contract. And I didn't know this at the time. It was just early in my professional trading career. But I would notice that the TF would tend to reject first and sell off ahead of some of the others, like the Dow or the S&P or NASDAQ. And so I looked at it as a leading indicator, and I would use it to help me identify ahead of time that some of the others would drop. And you know what? That's still the case today. The TF can tend to lead because it's the small caps. And they do tend to lead at times at these major extremes. So it's something that definitely can be done, absolutely. I don't do it all the time. I'm usually in the chart that I'm at, but there are definitely times where you can use these correlated or anti-correlated markets to help you make trading decisions. I don't usually teach based off of that, but that is definitely a viable approach. Do you think TOS will ever have order flow charts or a way to view order flow? That's a great question there, and I believe the answer would be yes. Something that I mentioned before was that when some software company comes up with a great idea, even if they have a patent or a hold on it, at some point, everyone else is going to get it too if it's a good deal and everyone wants it. That was something I talked about with the footprint. When Market Delta owned the rights to the footprint, nobody else could really have a footprint or call it a footprint, right? Because they had their little patent on it. Regardless of that, you still saw other competitors come out and you saw entrepreneurs building it. I saw the first versions in NT, NinjaTrader. I saw eSignal come out with something. Then you see, of course, Linsoft come out with their version as well. So everyone starts coming out with these. And then you see other innovators like Bookmap start to bring the visual dome onto the charts. And that's when you get the trail of intentions from Investor RT. So my standard answer is always, if someone else has it and it's good and people want it, they're going to get it into that platform. Otherwise, you're going to get people leaving. So I do believe at some point TOS will have that, and they do have a pretty good developer environment for the most part. So I believe that if the handles are there to grab that data, it should be fairly easy to start representing it onto the chart. So I think the answer is yes, and that'll be something that I'll look into as well, because we could build something pretty quickly or easily if we're able to grab that current bid and offer data and then visualize it onto the chart. That would give us a book map or trail of intentions type of indicator. So the goal with number 6 is patience and discipline. Just be patient, wait for the edges, wait for the right optimal opportunities. There's always another train coming. But if you get caught in the chop and slop, I mean, that's where things get hard. That's where it's hard to get paid to a T1. You start to get a couple of losses in a row in there, frustration sets in. All that can be avoided if you're just patient and disciplined to waiting for edges and waiting for proper trade location. So that's basically the 6 rules here that I usually use and the entry execution process that I typically look for when I'm engaging these opportunities. And now we're going to see what these look like on the charts. All right, here's our first chart. This is mostly about sharpening your ability to read a market's reaction to key prices. And I talked about before, key price levels that I like are previous high-low closes, overnight highs and overnight lows, and LVNs. Those are major price levels. And if you only just pay attention to those levels, you're going to do quite well. There's other key levels we pay attention to as well, like FOMC key levels, NFP key levels, whatever the case is. We have key data points that we can use in many number of ways. The good news is no matter what key level or data point you're using, your ability to read a market's rejection or reaction at that level is the same. it's the same. If it's a key level that the market's going to pay attention to, then you can read and watch for those major rejection signatures that you're used to seeing. So again, this is one here that played out here pretty recently, and you can see that the overnight high right here, ONH, previous RTH close right here, that's the previous, that's YCL. And this all happens after hours and wee hours in the morning, so nobody's really awake right there, as that's about 1 or 2 in the morning, and the thing drops. Then it drops down here and finds the overnight low, and that's more manageable, about 4 or 5 in the morning, and it pops up, right? Nice little box reversal ensues right here, nice little defense of the market structure and a drive, another pullback, defense of the market structure and drives. So that sets the edges for the day right there immediately. It gives you 2 viable edges to watch for rejection. So just coming into this day, you could look to say, that's a pretty decent overnight move here that defines the high and low pretty well. And in defining that high and low pretty well, we can now be patient and just wait. Wait for price to test those levels and then see what happens. And so when the market rallied here, it goes up, and boom, hits a high right there. Shoots through the previous close, shoots through the overnight high. And what do we know? The first thing to do here, this is what I always mention, as soon as you push through a high, or you push outside of R3, or you push outside of some key range, the first pullback will be defended by those aggressive market participants, right? Those are initiative participants that are looking to influence additional expansion out of that range or beyond that key level. So the first pullback right here, you know, is going to be defended by those participants, right? So you look for that to play out. You see this thing push through your level. All right, sweet. Now this is when you should start watching, right? Over here, I'm not really paying attention, right? If I'm looking for the edges, yes, it's going up, and you know, if you got in down here, or you can be playing pullbacks to that zone up there. But if you're looking to fade the edge, here it is. This is when the alarm bells go off in your head and say, now I should be watching, because now the market is at a decision point. It's either going to continue through the high and start pushing higher, or it's going to reject that high and come back to value, and perhaps across the value range, right? That's why I say I wait for the edges here. So step 1, we're waiting as price pushes through. Step 2, price pushes back, and we know that market participants are going to come and defend. Step 3 is watching that level right there. Right here. As price comes up, I say it all the time in the trading room. Are we going to form a lower high? Are we going to be a higher high failure? Or is it going to be a double top? I'll be honest, I never look to trade a double top. I don't care about double tops that much. I know some traders and scalpers will just, if you see this strong top and you think there might be a rejection, they'll set a limit order right there at that high and ambush it, but that's not me. That had been me before, and I got really good at that as a scalper, but again, I'm not sitting it right there at a double top. What I'd rather see is either a lower high here, because I know immediately as soon as the algos suggest or see that this is a failed high, before you can even blink in milliseconds, they've already changed and shifted their bias to sell side. As soon as the algos see that this is a rejection of this high, they've already shifted their bias to running the stops below this prior low and pushing downward. And if that is successful, if that is successful, then the next pullback is then defended below the market structure, and you see the continuation. That's why I'm always focused on this point right here. It's a 1, 2, 3. On the third leg here, what are we doing? Are we going to push higher and continue, or are we going to reject? One of my favorites, though, is the higher high rejection, because that's so simple to see at times. Price pushes above it and immediately rejects right back below it. It's like, whoa. That right there, again, offers an opportunity to get in and and push this thing back toward value. So again, it's just being patient about waiting for the edges. Down here, the same thing happened. Price came down to this edge and again was not able to establish acceptance beyond those lows. It came once, right? This is the one phase, number one. It drives down outside of S3. So now we're outside of third standard deviation value. And we are also outside of the overnight low. We've hit two edges. Nice confirmation. You know that on the first pullback, bears are going to want to defend right here. You know that. And then when they come down this way, are these bears going to get paid? Are they? Right here is the rejection. That's the earliest rejection. And that rejection right there is the signal that algos will use to shift the bias back to buy side and start running the stops, right? And then they go about it in a systematic way, and you have your edges, you have your zones where you can enter and trigger those entries. So let's take a look at that a little bit more in detail here. All right, this is the same opportunity, but we've broken it down to identify the various entry points for this setup. This happens to be a box reversal setup. So price drops down, it gets outside of range, right? It gets out beyond the overnight low, it gets outside of S3, it's below the 25% expansion target for the day. And what happens is price drops and forms a box, right? That box reversal is a powerful setup. It's a powerful setup. And one of the things to look for is these bears that are getting in late to the trend, are they getting paid? If they're not getting paid, the buy stops are at risk. These are the buy stops coming out. Boom. Then this is additional absorption and boom. And then here's a pullback and a defense and boom, right? So that's the first thing right now. Box reversal can be super, super powerful, but you have to know everything about that setup. What's the best case scenario for that setup? What's the worst case scenario? Where are the possible entry points for that setup? And so what I'm looking for here is, again, price pushes and drives, right? That's exactly what we're looking for, because now we're outside of the overnight low, we're outside of S3, so it's a decision point, right? It's a decision point. This is a decision point. Either we're going to continue to push through those lows and expand the range downward, or the market's going to reject those lows and we're headed back to value with a shot to go across the value range. Again, that's why I say look to engage those edges. In this box reversal, number one, price will drive down. Number two, bears will come in and defend a pivot here on that next pullback, because look how bearish this has been. It's dropping big time, right? And not much pullbacks here for these bears to really jump into. So this nice little pullback, that was one that bears were licking their chops for. They're like, yeah, this is the spot. This is where we get this thing and drop it to zero. And instead, as soon as price comes one tick, just one tick below that low, it's rejected right away. Right away. It's rejected, and immediately price is back above S3. So this is the high-risk entry for scalpers. This is a zone that some of the best scalpers will look for. And this is what I mentioned before. If you see this thing drive and you're anticipating that we might see a fade back up, a scalper would sit here and either put a limit order right on that low or maybe a tick or two below it. Right there. And whenever that zone is triggered, they're the first to get paid on this move up. And then you can get to a quick T1 here. Now I say that's a high risk entry because it is. You got to be very, very good. You got to be diligent. And if things don't work out right away, you got to be able to scratch. You got to be able to scratch. I am not advocating that you try this entry. I'm merely showing you where that entry is for scalpers. And this is one that I eventually got good at, but eventually said, I don't like it that much. Too much stress, too much focus right at that zone. I'd rather look for this entry here. It's after this rejects and squeezes, after the squeeze bar, the first shakeout leg or the shakeout legs back down, that's your entry. That's a retest entry. So the best entry for traders is number 3. That's what I call the retest entry. So after the squeeze, the retest is here, the retest is here. That's your best entry scenario. It offers the best trade location. It offers great odds for getting paid to a T1 first, because here's where the absorption is occurring, and boom, once you get that big push up right here, you can get paid on a T1 on that big leg up. And that's the goal. If you're entering here off the S3 or on this pullback zone, can you get to a T1 quickly? And in crude, T1 for me typically is about 10 ticks. Can we get to 10 ticks? Absolutely. Right? This is about 60 right here, 60 evens. Boom, it drops, it's about 75. That's 15 ticks on the first move. So you don't even have to be perfect on where you're at. You just got to get in, get on that first wave. And if you get to the T1 there, now you have additional options and flexibility, because now entry number 4 is the confirmed entry. I know some folks are scared about trading here, they're nervous about trading here, but once price pushes above resistance, it makes a little bit for a better, more confirmed entry, as bulls are going to look to keep prices above this market structure and drive it back to value. So this is the highly confirmed entry. But again, a highly confirmed entry doesn't mean it's the best entry. Because while it's highly confirmed, I would argue that it opens up the potential for more risk. Whereas down here, the risk is, I think it's a little better. You're closer here and you're not putting on too much risk. But it just depends on how you structure your trade management. But this right here is a great spot to not only have a confirmed entry, but also add back if you've already scaled out of a T1. So again, if you're looking here to squeeze and you get to a T1 and you've sold half of your trade, when price comes back to that level right here, anywhere in here, you can add back another quarter or another half, right? And then boom, now you can be in that trade on the way up again. So those are the major areas, and each of these setups have these same entry scenarios. There's the high risk entry where you have the initial rejection. There's the ideal entry where you have the retest entry. And then there's the confirmed entry with market structure. Those are the major entry points for many of these setups. They don't always happen, but variations happen all the time. So this is definitely something to look for every single time. Yes, it is. So right here, that's right on the high of that low bar. Absolutely. Great job on that one. And that's why I said that pullback is kind of the retest entry to that point, because that's where the stops came out, and that's right where you're at. Absolutely. Great eye on that. So this point right here, where the zone is defending, is right on the high bar of this rejection right here. The high of that bar. Great job. All right, this is from today's market. And this is the NQ. And this one experienced a major trend day type. Major trend day. And I'd even take a snapshot of the end of the day here. So it may have continued for all I know here. A very bullish advance that we saw. Significant trending market. Again, you've got to know your day types. Not only do you have to be able to know the day types, you have to be able to anticipate and recognize the day types ahead of time or as they're developing. My goal is to forecast or anticipate that a day type may occur, and then as it's happening, recognize that it is happening. Confirm that it is happening. And then continue to confirm as it continues along the path. We talked a lot about the trend day type today because that's what we had in the market. We talked about how bulls tend to defend rotations, the counter trend rotations at the optimal bidding areas. And in a trending day type, those areas are the LVNs and the PIMA trigger zones. It can also be R3 as well. R3 was bid in NQ as well. So an LVN is a low volume node right here. And in a trending price structure, this is called an imbalance phase. It's an imbalanced phase. I also call it the eye. It's an eye-shaped profile. It's just elongated, right? It's an elongated profile. Look how long that is, right? Now tell me, where is value in that chart? Where is value in that chart? Value's here. It was, here, it was here, it was here, it was down there, perhaps down here, right? Value continued to shift up throughout the day. And by the end of the day, was there really any consensus of value? No. Value is created by a balanced profile, a D-shaped profile. And instead, we got an I-shaped imbalanced profile. So the optimal bidding strategy in that type of market is to defend the LVNs on the counter trend rotations. So the first thing I mentioned this morning was, whoa. I said, wow, the market's just rallied big time here heading into the RTH Open. I said right after the Open, the first pullback into the LVN will be the spot to defend for a continuation. And if that plays out, the next LVN and pullback is the next spot. And if that plays out, the next LVN and the pullback is the next spot, until you fail to hold that price structure. Once you fail to hold that price structure, you either develop a range or perhaps you give it back. This one held price structure all day long. And so that's very, very important. When you're able to identify ahead of time that we may see this type of price discovery phase, then understanding how to properly engage that day type, and then knowing how to continue to confirm that day type as we move along throughout the session. All of those are very, very important. Additionally, this is one of those days where I mentioned even great professional traders can get slaughtered on a day like today. Because, again, if you're, like I said before, I've been to a point where I've made my account do this. I felt like I was the best trader in the world, so then I started doing things I didn't do to make the account go like this, and then you experience the drawdown, right? We all get to that point, but if you analyze that ahead of time, you're able to stop doing those things. But again, some traders get caught and trying to sell here, for example, and boom, this happens, and it's like deer in the headlights. I was using a mental stop, and now it's way against me. I'm just going to hold on, and hopefully it comes back. And boom, it's like, I just lost $20,000 on this trade. So it's a big deal to understand the day type ahead of time. So what gave you a clue that this thing would continue? Well, early on, it was the ES. Early on, it was the ES because of our 76 half key level. And that's a level that we've had on the books for a couple of years. It's a big time level. It's been a major target, and it continues to be a major pivot in the charts. So when price pushed up toward 76, my pre-market report was, if price gets above 76 half, watch for signs of rejection because it could be a fade back down, right? And so when we saw it live, and we were in the trading room this morning, and we were on the chat. We weren't quite on the mic just yet. We were on the chat, and that's when I saw the ES really push up. It went above 76 half, held for a second, and then burst higher again. There's no rejection there. So when that happened right away, my thought was, this is a price discovery phase unless 76 half fails. And so that was going to be my thought until something changes, right? And so if we looked at this and translated that to the ES today, this would have been 76 half. And price pushes here and holds for a second. And I was watching it for signs of rejection, and it does that instead. I thought, that's bullish the way it did that. And it's doing it ahead of the RTH. It's been driving already. VWAP was very sloped, and R3 was sloped at the time. So that was another indication, was that R3 was super sloped. We need to go with the trend right now until that changes. But I was constantly watching to see what would happen, but for the most part, it just continued to honor those zones. That's right. You're exactly right. At some point, the ES stopped. And that's what I mentioned in the trading room was, Um, as this thing matured, I mentioned in the trading room that it's not going to go up forever. It won't go up all day like this usually. I said at some point in the morning, it'll find a spike high, it'll pull back and find a low, and then it's likely going to trade in the range. The ES ended up doing that for the most part, while the NQ actually continued higher, and that usually doesn't happen. But it did in this case. So we knew what to anticipate with the ES, and eventually it went into that range. So again, we were able to forecast or anticipate that event with the ES ahead of time because, again, we know what a trend day type looks like. We know what to anticipate. We know what the normal look and feel is of these patterns. And if the market doesn't do what we expect, then maybe things are going to change. Maybe something else is going to happen, and that, again, is something to pay attention to. But yeah, we were ahead of both of those moves, and again, the NQ just continued higher, which was significant, but we knew right away, again, when this thing was pushing up, the first thing I said, look to defend the first LVN down here, and look to defend the trigger zone. So we pulled up the PIMAs. Look at the PIMAs. This is what I call the trigger zone. So for those of you that have gone through the proprietary training for Pivot Boss Master, this trigger zone is the space between the first two pivot-based EMAs, that space right there. When these things are stacked and sloped at 45 degrees or better in this case, all pullbacks and rotations into that zone offer the ideal area to trap and squeeze, trap and squeeze, trap and squeeze, right? And the goal is every time you trap and squeeze, look to get that new high. That's the goal. It's just a short-term counter-trend rotation. But it's something that you can play over and over until it fails to hold. But that was fantastic right there, how these played out. So again, you have to know your day types. You have to know what you're looking for out of these trades. And that's why we've been so successful in our trading room, because I'm really good with pattern recognition. This is what I was trained on. This is what I've done my entire professional career, was learning these markets through data and numbers. Because all I did was process and automate, process and get data, raw data, process it, automate it, and that's why I have my knowledge base, my firm knowledge base of how to engage these markets, and I don't deviate, because when I do deviate, bad things happen. So that's why I've had to be very disciplined about how I engage a market. But that takes time and experience. It wasn't like that 10 years ago where I was just flinging around, and I'd have a great day, and then 3 days in a row, and then I'd give half of it back on the fourth day. That's not the case anymore. So again, this is a powerful approach when you know what to expect. And I'll say one more thing about this. Knowing the day types goes back to preparation. Preparation. Remember Tom Brady, becoming an elite trader training? It was all about preparation. It's understanding what to do at the right times. And that 2-minute offense, what are we trying to, what are the goals here? What are we trying to accomplish? What are we supposed to do? What are we looking for? This is the same thing. This is preparation. We know how to engage this market type. We know what to look for. Yesterday was a sideways trading range day. We knew exactly what to look for and where. But it goes back to preparation. And this one is about practicing patience and discipline here. This is the euro. And again, I'm very, very good, typically speaking, about waiting for edges. It's something that I kind of trained or programmed myself to do, because I wouldn't really sit there and watch the charts all the time sometimes. What I would do is I would put an alert. So if I saw that this was a range-bound market here, I'd put an alert right here, and I'd put an alert right there. When it hits that level, now I'm going to look at the chart and focus on recognizing whether that's going to be rejection or is it going to be follow-through. So again, I kind of pre-program myself on how to engage these markets. Because if I was sitting there watching this thing the entire time, I'd want to get in here, I'd want to get in there, I'd want to go in here, I'd want to get in there. But looking at the overnight low, which is right here, these overnight lows, this is what I say in the trading room every single day. If you want to buy this market, wait for the market to push through these lows. Wait for it to push through these lows. They will come take it out at some point. And it happens here, and that's when you can begin to watch that market. As soon as this bar breaks through this line, now we got a ball game we can watch. Now we got a ball game. Now we also know that we are at S3. We have a flat R3 band. We have a flat S3 band. We have a flat VWAP. When these are flat, it's indicative of a trading range market. And the goal, the optimal bidding strategy, is to fade the edges in a trading range market and return price to value and across the value range. And again, if you're patient about waiting for the edges to be hit, there it is. Now, in this case, price bounces up. There's the low. That's right where the retest occurs. That's the retest. That's typically your best entry opportunity to get to a quick T1 and back to value. It's not always perfect this way, but again, we've seen many examples. They play out in many different ways. One thing I would say is it's based, whether this works or not, basically kind of depends on the current pace and tempo of the market. If a market is trading real choppy and like this, and that's your trading range, oh yeah, that could be a headache trying to find that low. But this market, look how fluid it was during this session. Look how fluid that action is. Real fluid movement, very, very nice the way it plays out. This is a much better, more fluid market with greater pace and tempo. That's a market you'd like to engage. If the trading range looks something like today's crude oil chart, remember I mentioned earlier, crude oil, oof, it didn't look pretty. We knew 49s were bid, but it didn't look pretty. And I said, you got to be careful here. And it was real choppy for a while. Eventually, those 49s went bid and bang, went right into the targets that we were looking at earlier. Right? It was those higher targets into the 50s, and it actually pushed beyond it. But again, it's all about the current pace and tempo, the fluidity of a market. If a market doesn't look appealing to trade, then don't trade it because it could be a mess. It could be a mess. But if a market is very fluid and organized, it's adhering to proper market structure, it's adhering to proper foundational market concepts of compression leads to expansion, those types of things, those are the markets to engage. So in this case, this was a great reaction here. We didn't even have to do anything here at all. If you just sat there on your hands, the market drops to the low and comes back above it and then comes and starts to sit. Already, that's a great sign that, you know what, prices below here they're not there anymore. They're above it and they're back above this low. I guess that's rejection or the beginning of a rejection, right? Over here, not so much. Over here, price pushes through the high, never breaks back below R3, and instead right here there's micro absorption off R3, and that forces a big drive up. When the market drives outside of R3 in this fashion, the optimal bidding strategy is to defend R3 on the pullback. There's a difference on this drive compared to others. If price pushes outside of R3 and just kind of does this and then it's already testing it, it's not the same. It's not the same. If it's doing this, it's not the same. If it drives through it, then coming back to defend R3 is a great idea for a shot at continuing this thing. Because if we are in a transitionary period here where we're transitioning from this sideways trade to this expansion trade, this could be significant, and that first retest is going to be huge. So again, it goes back to knowing your setups, knowing your patterns, knowing what to look for, what we're looking for in the market. You've got to be able to know your day types, know the optimal bidding strategies, know where all the entries are, and then you have to be patient about just waiting for those areas to be tested. And so again, this is another one of those opportunities here that you see in the market very, very often. So here's a good question. Have you ever noticed when price is moving up or down, an increase in volume comes in and the market usually will pull back, roll over, or stall? That's a good question because I have not really put up volume often in terms of volume at the bottom of the chart. I'm usually more focused on volume at price or volume weighted average price, but mostly volume at price. So I'm usually more paying attention to volume profile. And one of the things, volume at the bottom of the price is one of those enigmas to me. Ed Downs really swore and believed by it, especially climaxes and those types of things. In my study and data, I really never found a great correlation that I wanted to trade with regards to that. But that's a completely different ballgame from volume profile. When I engaged volume profile, there was immense ways to trigger entries, identify, and analyze the market via the volume profile. So I am a huge believer in volume, but the volume profile over anything else. But that doesn't mean to discount the volume at other times. I do pay attention to when the market is perhaps trading 30% below average volume or trading above. During holiday times, if it's trading below, it's a simple way to just stay out of the market. So I do pay attention in terms of that. And our last slide of this presentation is about reading the market's reaction to key prices. And this is perhaps one of my favorite examples here the recent month or so, because this was a fantastic opportunity, something we looked for from the higher time frame chart. This was a daily time frame idea where we had been in a very bearish downtrending market. Crude oil had sold off significantly, and after it sold off, we were in a down moving market. So basically price was up here on the daily chart, big drop, and then we had bounced, and then about right here, this is the day we're looking at. It's this day, and it was a failed new high. And so I told our traders in the trading room, if price goes above that high tomorrow, watch it very closely, because if there is rejection there, that could be an opportunity to sell it for the next major move down. And that could get us down toward 46.69 was the idea. And this was how it played out. And so the reason I'm mentioning this one is because it's failed range expansion, and it's also an absorption signature. And those are two of the most powerful concepts that you can combine together. And that's why I'm very diligent about just being patient and waiting for those setups, waiting for that opportunity. Because again, when we were in a major downtrending market, in the daily chart, the idea is to sell pullbacks in the direction of the trend. Sell pullbacks in the direction of the trend, right? That's the overall idea in a downtrending market in the higher time frame. So when you drop into the intraday time frame for trade location, this is the previous high right there. That's the previous high. And that dotted line right there says, or black line, it says YHI. That's yesterday's high. So that's the previous high. And when price pushes through it in overnight trading, pre-market trading, it fails to hold above that zone. It holds above it for a while, and then it drops back below it, right? So that's rejection. Ideally, you'd like to see, if you're a bull, right? If this thing pushes through resistance, you want to see it drive a little bit better. And then when it pulls back to the previous high, you want to see bulls defend and then get that squeeze going. Instead, what happened was this thing kind of dribbled higher a little bit and immediately closed right back below that level. It tried to see a pullback, and then, again, no dice on that higher high. Instead, it was a lower high failure, and price drops back below the previous high yet again. But after it drops back below, it drives, and then right here's where the absorption occurs. Boom, boom. It's a pinpoint precision area. That is the high right there. And then this is one tick beyond that level. That's why I say these are the best entries that you can identify in a chart. Because when price pushes through a recent high or low and it can't hold outside that range, you're likely going to see price come back against the range. And when we called this, the idea was if you sell it here or look for rejection here and sell it, the first trade is back to the previous close. Because if you reject prices above the previous high, you likely retest the close. Look at how price dropped into the close to the tick, and then that's where it bounced. Then it comes back again and back and back and back. It was like a magnet. Additionally, if this is a significant rejection in the higher time frame chart, remember we were in a downtrending market like this, and then this was the next spot right here. That was this part right here. If you're in a downtrending market, the structure means lower highs should give you lower lows. So you're not only just selling this rejection back to the previous close, but you at least know you're going to come down there and test the low, if not breach it, because, right, a downtrending market has lower highs and lower lows, lower highs and lower lows. This would be a lower low, just dipping its toe below that low. This was about a month ago on March 20th. You can go back in the chart and check that out. But this is so powerful. It's one of the most powerful combinations that you can come across. Failed range expansion and the absorption signature. And when you combine that with order flow, the footprint chart, and then you look for trapped buyers and sellers at that zone, then the real confirmation starts to come in. But when we talk about pinpointing, precision entries, I know a lot of folks that just wouldn't believe that you can pinpoint crude oil to the tick as an entry and then get this positive, favorable excursion in your favor. That's a $400 per contract move right away. And by the time it's way down here, I mean, it's $1,400 per contract. That's a powerful move with no movement against your entry zone. And again, this isn't hindsight stuff here. This is the analysis that we provided to the trading room the day before. The day before. And it wasn't even the day before, it was the morning before, because our trading room ends at 11 a.m. Central. So the morning I was talking about it, the pre-market I was talking about it, and you can see the rejection came. Not only that, but there were traders in the room that got it. There were traders in the room that came in and said that was an awesome call and I got in on that move. And you can see the result. That was a huge, huge move, right? So again, when you're looking to pinpoint precision entries, I usually favor toward waiting for the edges of a major range or staying in the direction of a range, in the direction of the primary trend, and then looking to reject against that move. So if we're trending downward, then failed new highs is a perfect selling opportunity. If we're trending up, then failed new lows is a perfect buying opportunity. And this is one of those that was picture perfect. So in this case, anytime you're looking at a major rejection from a higher time frame and you're zooming into the intraday chart, this is one of those opportunities that can pay you on a swing basis, because this thing continued lower over the upcoming couple of few days and dropped into the 47s and got into about 47, 47.10. So it dropped another buck from this low, right? And once you have that major direction and it's confirmed, any pullback offers a selling opportunity. Any pullback along the way, any of them, right? As long as you continue to print new lows. As soon as one of these pullbacks rejects, then you might either form a range or you may see a move to VWAP. But this is something where you can really believe in these setups, these signatures, these rejections, and then you can pound the table when the thing starts to work out, right? When this day starts to develop, this is the day where you step on the gas. But when you have those days where you think everything's lining up, this is the zone, and the optimal entry is right there. That's a precision entry. But is that the only entry? No, that's not the only entry. Once price breaks down here and breaks below these lows, there's additional entries here. There's a failed new high there, right? Once price breaks below support here, there's additional entries there. There's entries all over the place. But once you know what's happening, you can then know what to look for in the charts. If you have no clue what's happening in the charts, oftentimes it's best to just stand back and go to a higher time frame view, try to get a better view of what may be happening, because if you can't tell heads from tails, it could be very, very difficult. But when you know what's about to happen, that's when you step on the gas. And this is a perfect example of that. And I think this goes back to the one final point that we'll make about this course, Pinpointing Precision Entries. If you sharpen your ability to anticipate forecast where these rejections can occur, and then sharpen your ability to read the market's reaction to these key prices. I think that's about the most important analytical skills that you can build, because if you build those skills, you'll have a really good idea of what you're looking for and when. And when you're not seeing it, you just don't engage. And when you see it, you engage. And not only that, when you really see it start to work, you push it. You push the ball up the court. So this right here is one of the most powerful combinations that I've come across. And sharpening your ability to forecast and anticipate where these will happen. Again, a previous high. That's how I was able to forecast and anticipate it. And then once you see the rejection signature, right, the absorption signature, the failed new high, then we know what to do. So again, sharpen that ability to forecast these events, sharpen your ability to read and react to the market's reaction, because when you can do that, then you can pick your entries. We're going to take this, and now we're going to go down into the footprint. We're going to go down into the footprint. We're going to confirm with the footprint. So we're going to look at these opportunities. But what does the order flow look like there? Because once you're able to confirm with order flow, that's when you really start to really believe in that trade. When you're seeing the order flow, that's where it makes it really real or a mirage. So that concludes today's training, pinpointing precision entries for Pivot Boss Masters. This is under our core training and execution portions of Masters. I still believe that being able to identify precision entries is extremely important, because minimizing that adverse excursion and getting to that T1 target are the most important things after triggering an entry. You want to experience the least amount of heat possible, and you want to get paid first so you can scale and get to a break-even proposition there. And pinpointing these entries makes all the difference. So use some of these concepts in your trading. Let me know what you think. Thanks everyone for joining me for Pinpointing Precision Entries. We've got more great content coming your way.